Hello, this is Nasir Qureshi Realtor Daddy from Houston, Texas. We're back on demand with Wisdom Wednesday for real estate professionals, and we have a very good session lined up. I'm a realtor licensed in Texas. I practice residential and commercial real estate, and website is realtordaddy.com. I live in Northwest Houston with my wife and 3 children, certified solar advisor and an author. And I have a very, very special guest, Mr. Edi Shek. He is a mortgage and lender expert, licensed in the state of Texas. And upon my request, a humble request, he gave us some time so we can learn a few things from him. So hello, Mr. Edi. How are you, sir?
I'm doing great. Thank you very much. And thanks for your invitation. Can you hear me clear?
I can hear you clearly, sir, and thank you. And I can see you clearly. Appreciate it. So what we're going to do about 45, 50 minutes, a maximum hour. I will ask you about yourself and company. What do you do? Some opinions, some assessments, or things like that. So I can learn and others can learn from you from now, and this is going to go into YouTube. So tell me a little bit about yourself, who you are, and where are you from?
Okay, so my name is not a problem for you. It's Edi Shek. My name spells as EDI. It means brother, elder brother, actually. It's an Indonesian name, Edi Shek. So I'm a licensed originator, residential mortgage loan originator. And I'm also on the mortgage company called Zapa Mortgage. So my NMLS number for me is 216981. And for Zapa Mortgage, the NMLS number is 357630. The information that we are going to share is more on the general nature. If you have any specific questions, we shall be able to answer that questions. I will leave my number here and you can reach out to me anytime. First thing, I started in 2008, right when the industry was going into or recovering from the last mortgage crisis. So I started in 2008. And since then, it's 16 years. In the last 16 years, there are more than 100 new rules, regulations were formed. And I actually went through all of them one by one, learned them along the way, and seasoned them. So I'm the Texas expert. When I say Texas expert, Texas has some special rules that does not apply in any of other states, and the special laws that are here. So across other things, like if someone is doing it from another state, they may not understand exactly what are the challenges there, but they will be able to overcome one way or other. It will take a little longer, but I'm doing it only in the state of Texas. Texas is such a big state that I did not have a need to go beyond Texas. Now, I'm helping a lot of people moving from New York, Colorado, California, Seattle, other states, Virginia, back to Texas. And a lot of my clientele actually are Desis who want to move to Houston because there's a bigger Desi action here, a lot of nice food, big community and all that stuff. And then on top of that, Houston probably is one of the major city with the cheapest or lowest real estate. So imagine that the same kind of home that we have here for $300,000, you will get it for $2 million in Los Angeles, or maybe $1.6 million in New York, or maybe $2 million in Chicago. You can get the similar kind of home for $300,000, $400,000. Okay, so you cannot beat that. So that's a little bit of introduction. So I do all kind of home loans, residential home loans. I do touch some commercial real estate, but most of my target is serving the residential market. So my job is to put you in your home.
Okay, fantastic. So I'm curious that what got you in mortgage industry? Why mortgage industry?
Oh yeah, so I'm IT expert, and when this 2008 crisis happened, all the major corporates were tightening the belt. So I'm an IT expert as well. So I thought, you know what? I'm fed up with this IT. Every now and then we have uh, technology changes. I'm expert in the technology and become obsolete. I have to continue learning. And then once I become a little bit more expensive, I'm replaceable unless I climb up the ladder, start managing. So I did started managing, but when this 2008 crisis happened, so I wanted to do something where I'm doing IT and no IT. So this is no IT. So I started mortgage because it is not IT.
Right. I did some of the education in business computer information system, and those were golden days too. But I was not really up for it. Okay. So mostly you do residential, and we have networked before, we talked before, and we got to know you a little bit. And I really love your style, though. That's one of the reasons that I invited you is uh, you just don't pitch your business presentation. You have a very good tendency and style to educate a person in going details to paint the picture. I mean, buying a house is a big decision for anybody, right? It's an
After, yeah,
emotional
it is.
attachment too. Yeah.
It is. It is. And being a homeowner myself, I know the difference. I used to live in an apartment complex and I moved into a tiny home. And my kids were like going to grade three, grade one and grade three. And they needed space. Yeah. Townhome was bigger than apartment, but really I needed to move to a bigger place for my kids to grow up and all that. So overall, I was able to not only I got 30-year loan. Okay, I
Mm.
did not do my own loan, so I got 30-year loan, and I paid it off in 12 years. And there are techniques that anyone can do that. I can tell you those simple techniques that can help you pay your loan faster. But nevertheless, um, uh, it is at the end of the day, with all the troubles, it is very, very good. Now I'll tell you one thing, since you mentioned joy, after 2008 crisis, the government ensured that we don't get another crisis. So that's why you see during COVID, the real estate market did not crash. It did not crash because all the rules, all the things that were in place that caused market not to crash. Not only that, it actually appreciated. A lot of people made a lot of money, and business expanded. Okay, um, the loan process now is not very easy. Okay,
Oh yeah. Oh yeah.
the 2008 crisis happened. People were giving loan like this. Oh, you got pearls? You got pearls? Here's the money.
Yeah,
Literally, that was the way in 2008 and before.
correct.
Now we only give loan to people who can afford. That's why
Exactly.
when COVID happened, people did not foreclose because they were in the first place able to afford it. Okay.
I'm glad
And
you mentioned that, as and I was going to lead you before we get into different kind of residential loans, right? I want to start off with, let's say, to average American or average applicant or this person that has desire to buy a home out there on YouTube or anywhere, what they're making a first time call, they just made a decision, they want to buy a home, right? And I know, being a realtor and an American, that credit for most of the people is very challenging. So, what is the good starting point for average person in a simple way? What is the starting point? And if they are not ready, how can an average person can start to get ready to get a loan?
so I have a whole presentation that I can share along the way with you.
Go ahead,
It's
please.
lined up. I'll be sharing that. But to answer that question, I want to summarize it first. So
Okay.
you started asking about credit. Yeah, credit is one of the components. There are total three things that we need to verify. We need to verify your income, your credit, and the money that you're going to bring to the closing table. You're buying home, right? So you need money. You need credit because otherwise lenders will not rely, you know, feel you credit worthy, and you need income to show. Now, in good old days, you did not need the income. The 2008 crisis happened when a person whose salary was $3,000 was carrying $12,000 worth of mortgages, and he was moving the money around with his credit cards and everything. And suddenly, all the credit card companies cut the credit limit, and no one was able to borrow. And then eventually, this thing collapsed. Uh,
Mm-hmm.
of course, the problem started in the first place because one person was carrying more, 4 times the mortgage than his income, which was already wrong. But at that point of time, the US government, we, the people, everyone wanted American dreams to be fulfilled for most of the people. So the credit was open to everyone. Now it's not. Now, when I say we need to verify your income, there's a law called ATR. It's called ability to repay. Ability to repay. We must document one way or other a method where we can make sure that you can make your payment. And it's very simple formula. And I will give you that magic formula as well. The magic formula is very simple. I give you this formula. If you follow that formula, you are qualified or you are not qualified. It's that simple. If you have any outstanding student loans, car payments, you co-sign a note with someone, things like that. And what is your credit score? Your credit worthiness is based on these two factors. And then down payment is how much money you can put down. And down payment is one thing. The cash to close that we usually, the term use, the day you go and sign all your paperwork and get your home key, that day, the money that you bring is called cash to close. And that cash to close is composed of 3 things: down payment, closing cost, and prepaid. Down payment, closing cost, prepaid. So it's only down payment here, but yeah, that's the money that you will need. So what we do is when anyone calls, say, hey, I want to buy a home. So what do? We ensure that this guy is able to afford certain amount of home. Okay. We just don't want to give loan to anyone who cannot afford. The government does not allow us. Okay. Moving to that next. One thing that I would want, you asked this question, Nasir. You asked this question, where should we start? Okay,
Correct.
if you're living in the US, you're buying home or not, doesn't matter. You need to maintain your credit. Your credit, you know, shows you how much opportunity you're going to get. And in a lot of cases, I don't know if the people who hire, they look at the credit score, but, this is something that is needed everywhere. So you can go to this website called Annual Credit Report. This website is funded by FTC, Federal Trade Commission. There was a law, it allowed each and every one of us to obtain our credit report once a year for free from all 3 bureaus. Okay. So you can go to this website and you can get your free credit report today. You obtain the free copy of your credit report. You see that if there is any delinquent credit, you can pay it off. You can negotiate with them, or you can hire a credit repair expert who can look at that and then he can save some money there. If there are any discrepancies, you fix those. Make sure you pay your bill online and keep your credit card balance low. If you're not ready to buy a home, keep your credit card balance less than 30%. So if you have $1,000 credit card, your balance should be $300 or less. But when you are ready to buy the home, you bring it down to 10%. It's better. But it's not end of the story. If your credit is not good, not excellent, we can still do your loan. Usually, most of the lenders accept the credit score of 550, but you will not get very good deal. Okay. It's like, if you have best credit, you will get the best deal, and vice versa. So to be on the safe side, 620 and above is good, but 700 and above is better. More is merrier. Any question you have, Nasir?
No, I'm really is enjoying the process and it's so beautifully explained. Thank you.
Yes,
Please
sir.
please
So
continue.
So you need down payment. First time home buyer can pay anywhere between 3%, 3.5%, or 5% as a minimum down payment. And that depends on how much is your income. If your income is 80% of area median income, then you can put 3% down. If your income is higher, then you can put 5% down for a conventional loan. But for an FHA loan, despite your income, you can put 3.5% down. Okay, you can start saving money for your down payment. Okay, now there are closing costs, but you need to save money for down payment. You need to save money for closing costs. You need to save money for uh, prepaids. Okay, that closing cost actually includes taxes, insurance, appraisal, and other fees, and it range anywhere between 2 to 5% of the loan amount. Okay. Now there are some techniques that we can put a person in the home for less money. Okay, but it will. There's a trade-off. It may increase your interest rate or monthly payment. There is a trade-off. Okay, there's nothing free. It's like one blanket that you need to fit. You put it on your foot, your head will be naked. You put it on your head, your foot will be naked. So we need
Correct.
to make sure that we adjust it accordingly. So if you have anywhere between 8 to 10% of the purchase price, you can buy the home without any issues. You have less money, you can still buy a home because there is something called down payment assistance programs. Those programs are city, state, county specific. They're related to what's called, they are related to, uh, you know, income, family size, and other aspects. Brother Nasir, are you seeing any delay or feedback on my side?
No, just a little bit of voice. Sometime it has echo, but
All right.
yeah, the picture comes a little bit slow, but just a little echo on the voice sometime. But other than that, I can see everything, can hear everything.
All right. Okay, so there's something called wholesale loans and retail loans. Okay. Now I want to explain to you what is the difference. The retail is like all the big banks with the branches. That's called retail. Okay. Which means that you walk into a branch, people greet you, they're wearing nice dress like what I'm wearing today, for example. And then you work with them and they lend their money. Usually banks have only one program for you. We work with wholesale lenders, and there are like 40 plus lenders that I work with, and each lender offers 3 to 5 different type of programs. So if there's any challenge, we have a loan program to fix your problem.
Excellent, excellent. Yes, sir.
Already. So you work with loan officer, doesn't matter it's a retail location or a wholesale location, because all of us here licensed under the same jurisdiction. It doesn't matter you go to the number one bank in the US or me or anyone else who is doing home loans. Is called loan originator or loan officer. Okay. The full name is called residential mortgage loan officer. But in our case, loan officer is the one who actually, just like doctor, listens to you and propose you what loan program is best for you. Okay. And it also calculates what you can afford. So before you shop, what you have to do is you need, when you're ready, want to go and see the home, you need a pre-approval. Okay. There's a difference between pre-approval and pre-qualification. Pre-qualification is you talk to me, you tell me what is your income and everything, and I'll tell you, yeah, you can afford it. But if you want a pre-approval, you need to show me your documents, and I'm going to work those out, and I'm going to document and send them over to you. Okay,
Correct.
that's called pre-approval. So with a pre-approval, you can go and shop, and you can actually make offers. There are different kind of documents that you need. You need to provide 30 days of pay stubs, W-2 forms for last 1 or 2 years, tax returns for past 1 or 2 years, 2 months bank statements. And if you are self-employed, you need to also provide business tax returns, profit and loss statements, even balance sheet in some cases. And that is when we are doing full document program. You need to have proven income, and this is the way to prove your income.
Fantastic. Great.
When you go shopping, make sure you get a buyer's agent. Never buy a home without a buyer's agent, because you don't know what's going on in the real estate industry. A real estate agent usually is paid by the seller at closing. Okay. The things can change, but usually what happens is that the real estate agent has a fiduciary duty to work for you. Okay. Just like a real estate agent has duty, me, the loan officer, we are in your team. Our job is to get you in the home. Same thing goes for the real estate agent. We have vested interest, both real estate agent and a loan officer has a vested interest in getting you the best deal. And usually what you can do is go and find a real estate agent, and based on that, start working with them. You need to appoint your buyer's agent. The buyer agent will guide you how to make an offer. He will show you CMA, which is comparative market analysis. It will tell you what is the difference between and how to make an offer. And there's a procedure of offer and counter offer. He's going to run it with you. And there you go. You need to do, once you make an offer, you need to submit an EMD, which is basically hold the money. Now, there are two types of EMDs. One is called EMD, which allows you to buy the home, but there's another something called option fee. Like you pay $200, $300 as an option fee, and it allows you to think on this offer for next 5 or 7 days, get the home inspected. And then if you don't like it, you can walk, but you need to give up that option fee, but you will get your earnest money deposit, which is EMD, back. So you can get the inspection, you have to pay out of pocket for the inspection. Inspection costs anywhere between, $500, $600, $350, $400. The good inspectors cost more, but they will save you a lot of money. Okay. And for any reason you have to get more than one homes inspected, usually they can offer you some kind of discount. And you can always reach out to Nasir or this forum or me for that purpose if you're looking for a reliable inspector. So next step is, the loan application. The loan application is a form. It's like a 7, 9, 10 pages form, depending on your circumstance. You need to fill this form. The good thing is that you don't have to do it on the paper. It's electronic, okay? It's electronic mortgage process. You just fill it online. And we can guide you through the process. So the total home value, you buy a loan amount, and this equity is your down payment. So which means, for example, if you're buying a home for $400,000 and you're putting 5% down, that is $20,000 equity in the home, and the rest of the $380,000 is your loan amount. There are different kind of loans: conventional, FHA, and VA. There's also one more called USDA, and there's also land loans. We are just talking about most common residential loans in the urban setting. Conventional loans, and all these loans also, I believe conventional and FHA also come in full document and alternate document method types. Now, next thing is interest rate. I want to tell you one thing. Okay, before we continue, there are fixed rates and adjustable rates. The fixed rates stay the same during the life of the loan, and adjustable rates can change, can go down, can go up. Okay, which one is better? There's not a right answer, right or wrong answer. It depends on your situation. But for most of the people, the fixed rate is better. Now I want to tell you one more thing on the rates. Not a single person controls the rate. The big banks, they don't control the rate. The rate is controlled by our economy, the stock exchange, the bonds, the government bonds. Okay. The Fed Reserve, when announce something, the bonds rate go up, the bond rates go down. But depending on that, the interest rate for the homes, for your cars, everything adjusts. It's the market rate. If someone tells you that this bank gives you lower rate than the other bank, that's not the case. It's the different type of risks and different type of fees that causes the rate to go up or go down. If you choose a loan originator who knows what he's doing, he will be competitive and he will be making sure that you close the loan fast. So for competitive, of course, I'm going to throw my pitch, Nasir, here. You can always reach out to me.
Yeah, sure.
All right. So underwriting is next process. There's a special person called underwriter who does the underwriting, and that guy actually goes through and verifies all the information. This is by law we have to do. There are rules enforced, enacted by the US government that we need to follow certain rules. There are two bodies called Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac have a set of rules, almost 5,000 pages. Okay, those pages you can actually, they have written all the rules. What happens if you're making this much money and your liabilities are this much? What property you're going to buy, how much money do you need in your account? All these things are taken care by underwriter. But when we submit the loan, we actually underwrite it internally, manually, before we submit it. Next thing is appraisal. Appraisal is the lender's way, the person who is going to give the money, way if the price is correct. So this is a fee that you have to pay before closing. The good thing is that in the loan process, you only have to pay in the loan process with us, you only have to pay one thing before closing, that is appraisal. Okay. Everything else you pay at closing in the loan process. Now,
Yes.
out of loan process, you may have to pay for inspection, or you may have to pay HOA for their statement fee, but not to us. And then industry standard usually was 30 to 45 days, but we are closing loans fast. On average, we are between 11 to 20 days. Okay, actually, we are 7 to 20 days, but 7 is the minimum number of days that you can close technically due to the rules and regulations. So we have closed loans very fast, mostly less than 15 days. But we always ask you to buy at least 30 days from your seller that you are going to close the loan. Okay. The closing date does impact the final cost. If you're closing in the beginning of the month, the closing cost may be slightly higher compared to closing at the end of the month. And one fun fact here, if you close on, for example, 10th of March, your first payment is going to be 1st of May. You don't have to make payment the next month of closing. So closing in March, you don't have to make any payment in April. Your next payment is going to be, the first payment is going to be on 1st of May in that particular scenario. And closing day is the happiest day. It can take anywhere between 1 to 6 hours. Actually, nowadays it is taking less than 2 hours. Both seller and buyer, they go separately. They need to sign the documents. Once everything is done, okay, the loan is funded and keys are released to the buyer. One happy day. Okay.
Yes.
So basically that's what we are here. Now I will stop here because that's a lot of information that I covered. I think we can go to questions if we have.
Yes.
And
Beautiful information. Today me and my client had the happy day. So we had a closing today.
right.
So it was a great experience, and I was very happy to fulfill their home ownership dream.
Mhm. Yep.
Can you see me and hear me clearly?
Yes, I can see you. I'm trying to stop this. For some reason,
Screen, yeah,
Zoom is
your
very
screen.
slow. Yeah.
No problem. There you go. It's stopped. Yeah.
Okay. There you go. So I turn on my camera now.
Your presentation was excellent. Not too short, not too long. very explanatory, not too complicated, and well done. I loved it, and that it really
Yes.
explained. I mean, this presentation was much better than some of the courses that I have paid for.
No worries, no worries. Actually, I asked my team, hey, I'm going on a call, video call today, and it will be recorded and it will be presented in the YouTube. It is going to live forever. So what
Exactly,
should I
yeah.
present? And they said, oh, keep it simple. Don't try to,
Oh yeah.
make it complicated. Keep it simple. And this way, people will remember. And if you have any question, you can always come back. So the points, they actually given me pointers. They say, you tell people how to maintain and improve your credit. This is something my assistants, they always help me with the initial process. And they're saying that most of us have issues with our credit. And
Right.
you don't have to fix your credit only for your home. If you're living in the US, you keep your credit top notch. We have gone through a lot of communities, and I can tell you what communities have always scored more than 760 and above.
Mm-hmm.
And I can tell you which communities have lower score. Okay.
Mm-hmm. Mm-hmm.
It's like some people are stayed on top of their finances, their numbers, their bills, and some people don't care
They
until it's
don't, yeah.
yeah. So my advice to anyone and everyone, if you want to learn one thing, only one thing from this session, is keep your credit score at top-notch location. Okay.
Yeah, and in many professional license seeking an application, I'm not
Nowadays.
yeah, nowadays I'm not a lawyer, but my lawyer friends, they went through the process of getting a license, and they told me that they also asked them to check their credit, and if the credit is good or not, and what the government or state bar is looking at, that if this person is good and responsibly care for his financial affairs. If he or she cannot do for himself, how can he
Mhm.
do and manage the
For other people.
funds of for other people?
Exactly.
So
So,
it's financial, yeah, I think, and yeah. So I'm not sure if you're still trying to fix your screen or not, but just letting you know, I cannot see you, but that's okay. I think you probably still trying to work the screen.
the
It's just
Zoom.
it's a blackout, yeah.
Oh, okay.
But I can
Uh,
hear
the,
you well, but it's just a blackout on your half of my screen, and I can see myself. Maybe
I'm
so.
lost in the lending maze.
Yeah, it's a Zoom thing. Yeah, I'm still mastering, but I can hear you well, and we can continue to talk and things like this. You mentioned the prepays, right?
Mhm.
On the table, and that is uh talked very little about and less about. And sometimes it's kind of like a sticker shocker, what they call it, shocking, right? For people, hey, I wasn't told that before, and can you just a little bit elaborate on those prepays, some cost, and a little bit on escrow? Can you touch up on that?
Oh, definitely. So there's something called closing costs. Closing cost is, after 2008 crisis, the U.S. government, Fannie Mae, Freddie Mac, the CFPB, all the bodies involved, and a lot of industry people like me, they got involved in a process, and they identify how to best present these things to you. So there are altogether 10 sections, section A, B, C, and section D is the total. And then section E, F, G, H, section I is the total, and then section J has a total. There are some numbers, G, H, I, J. Okay, so I is another total. So all these sections have different kind of fees. So I want to tell you, and if you're listening,
Sure.
everyone need to understand section A is what related to the lender. Okay. And then there's something called APR. APR is
There
the
you go.
thing
I can
that
see it
allows.
clearly now. Yes,
Oh,
sir.
okay. Thank you. I'm back. So section A is the lending fees. Okay. Section B and C are mandatory fees which are required for the loan to close. Section B are the fees that mandated by the lender. The lender requires them, but provided by third parties. And section C is where you can choose if you want to go and buy from someone else, but usually more people don't know how to do it, and the real estate agent help them with the process. So section A, B, and C fees are the closing costs. These are typical loan closing costs. Okay. Now section E is recording fee, usually transfer fee or whatever. Section F is your prepaid. Okay. The prepaids include 1 year upfront homeowner insurance. You have to pay upfront. And then second thing is that if there's flood insurance that you have to pay upfront. And then variable number of days interest. For example, if you're closing on 20th of a month, so you need to pay the interest from 20th to 31st. That 11 days interest you have to pay. Okay, whatever it is. Because interest is always paid in accrual. That's why you close on 20th of March. You don't have to make payment on 1st of April. The first payment is going to 1st May. Because on the month of April, the interest is accrued and you pay on 1st of May. So in prepaid, section F, you have to pay the interest rate for X number of days. And then section G, if there's a escrow in the loan, like you have two methods to pay property tax and insurance. Either you pay yourself on annual basis, or you pay monthly basis to the escrow account. It's a Amana account or escrow account. It goes into the escrow account. At the end of the year, the lenders reach out to escrow account and pays. That's called escrow. So at closing, if there's an escrow in section G, you have to pay this money in advance, 3 months worth usually. So 3 months of tax, 3 months of insurance, then 1 year of insurance, and your interest. More or less, these are called prepaid. Means this is not an expense. This is not a cost. This is the advance that you're paying. So that's called prepaid. Now, so we talk about closing costs, we talk about prepaid, and third thing is the down payment. I put 5% down. I put 3.5% down. Or I put 20% down. That's called down payment. So these are the three components make closing costs.
Fantastic. Nice explanation. I could see, when you were talking, I can see the CD. I can visualize the closing disclosure
Disclosure.
statement. I can go like line by line, right? For people
Yeah.
who don't know what CD is. So we have 15 minutes more, like 10, 15 minutes more. So I would like to talk and ask you a little bit about um, just a little bit different types of loans, and like especially in the past few years, this balloon loan have become very popular among the millennials, right? And can you touch up on what is a balloon loan, and what is a $0 down loan?
Okay.
Can you touch up on
So
that, please?
there are a few things. So balloon is just a term that you're getting the loan for maybe 5 years. So they calculate the payment based on 30 years. Okay. But they give you the loan that is to be cleared or closed in 5 years. Okay. And there are different kind of loans in that area as well. This is not very common nowadays because the lenders are not offering it. The cost is high usually, but it's not a bad idea. I do have one of that loan for myself as well, balloon 5-year balloon loan. I was buying some kind of land and I got that one. That is, I really liked it. But nevertheless, the other is a zero down loan. Now, let me step back and tell you what do you mean by down? Whenever you're going to do a loan, but get a loan, Fannie Mae, Freddie Mac, FHA, the HUD, VA, not VA, they require you to put some money down. They want your skin in the game. So you need to put 3% down or 5% down for a conventional based on your income. And then you need to put 3.5% down for FHA. So there is no loan called zero down loan. But what we can do is we can do one of the two things. We can get a down payment assistance of 3.5% or down payment assistance for that 3%. Okay. So someone else is paying for that 3.5% or 3% or 5% component. So to you, it is 100% loan or zero down loan, but it's not zero down. Okay. Now, if it is down payment assistance, there are two kinds of down payment assistance. One is forgivable. They give you down payment, but they tell you that you need to keep this loan for 3, 5, or 10 years, depending on the loan program. Okay. And if you refinance within that period, then you have to pay that down payment. It's not free. It is forgivable down payment. Okay. But if you refinance it, for example, you got it for 36 months, and after 6 months you refinance. So you still have to pay the 30-month balance because you did not live there for 36 months. It depends on the loan program. And you need to qualify for down payment assistance. It's not given to everyone, unfortunately. It's not a free for all type thing. You need to qualify for that. And a lot of time the seller does not agree to wait for down payment assistance to clear. Now, there are many kinds of down payment assistance, and I think we can have a separate session on down payment assistance.
Yes, correct. No problem.
Okay, but for now, down payment assistance is for people who have credit, who have income, but don't have money. Okay, it's not for people who don't have credit, don't have income, and then they say, give me money to buy home. No, it doesn't work like this. These are three things. You need to have income, some income. You need to have credit score. You have some money, and some of the money is given as down payment assistance. You are going to be put in the home if you can afford it. If you cannot afford it, you are not going to get that. That's as simple. That's ATR, ability to repay. Now, second type of down payment assistance is not exactly a down payment assistance, but it's a second loan. So you get a 96.5% loan, and then you have a 3.5% loan. So you pay for this loan, and you also pay for this loan. The monthly payment can go up, but you bring zero payment, $0 down payment. Now, we have a funny thing you asked, and I will explain this. We have a loan program today. If seller is contributing some money towards closing costs, you can literally go into a $400,000 home with $1,000 out of pocket.
Wow. Nice.
Okay? Or you can watch some of my TikTok videos. You can go into a $300,000 home for $200. And you don't have to pay for the next month. You will pay the following month, the first installment. Okay. But these programs are not free for all. These are for those people who have credit, some credit, have income. Now, in today's world, the US government does not allow us to give you a loan without documenting your income. Now, when we say documenting your income, there are many ways to document your income. You know, 3-4 years ago, the only way to document income was look at your pay stub, look at your W-2, look at your tax return, look at your bank account that money is coming in, and then I write in blood that yes, this person can pay his payment. I vouch for him. Please give him money. Okay. So a few years back, the lenders became creative and they said, you know what? The US government asked us to document this person has ability to repay.
Yeah.
Now, then we came up with alternate methods to document how we can give him the loan. Now, there are funny loan programs came into being. Your employer writes it down, tells us that Mr. Nasir makes $10,000 a month. He gives us his written document, we take it, we use it. We got documented proof that this guy is making $10,000. In that case, we don't need to see his income, his pay stub, his W-2, tax return. No, we don't need anything. We just need one paper. Okay. The lender usually charges 1% higher interest rate for that kind of thing. So if the going rate is 5%, you are going to get that loan for 6%. Of course, the lender is taking additional risk by accepting alternate document. His neck is on the line. Okay, so he's going to make more money out of it. Now, funny thing, there are other loan programs as well. If you are self-employed, one of the loan program which is very popular is bank statement loan. For
Mm-hmm.
example, you have a
Yeah.
gas station. Okay, everyone uses credit card on gas station. You have $40,000 deposits every month in your gas station. 38, 42, 45, 50, 35. We take 12 months deposits. And for example, in whole year, you deposited $2 million. Okay. We take 1/4 of it, in some cases more, in some cases less, as your income. So if there are $200,000 deposits, $500,000 is your income. And if you have your partner, 50% partner, your income is $250,000. That will allow you to almost buy a $2 million home. But the interest rate is going to be higher. If the regular interest rate is, for example, 6%, you will have to pay about 7.25 or 7.5% interest rate.
Mm-hmm.
The lender is going to take that risk because he's trusting you that you make a lot of money. The lender is not looking at your tax return, your W-2, your pay stub, anything. He's just looking at your bank statement and say, okay, you know what? This guy is playing in $2 million every year. I trust him. I give
Right.
him money, but I will charge you extra fees. Now, to buy a $2 million home, probably you have to pay 4 times the money that lender is making to qualify based on full document.
Mm-hmm.
If you're making $250,000 and showing it, you are paying about $40,000 in taxes. Here you will be paying 15 extra $1,000 most probably, or more or less in interest. So it's a win-win. It's like right in the middle sweet ground. That's how most of the lenders look at it. They try to cover their risk. They try to make extra money. To buy a home, you have to pay taxes to Uncle Sam, or you have to pay to these alternate lenders extra in interest. There's no escape, unfortunately.
Great,
That's what I think.
very well answer, Mr. Eddie. So we have last 6 minutes left, and
Oh,
I
wow.
know this is uh so many different types of loans and this and that. We can have like so another few sessions on this topic, very comprehensive, and you were very fundamental and generic and basic in a simple terms. You explained beautifully, but I promise my viewers that I'm going to ask this the most popular and crazy question that begins the conversation between the two any individual is this. In last 5 minutes, can you touch up on that what are the interest rates and when the interest rates are going down? And
Okay.
if we go a little bit 5 minutes more over, that's fine. I'm going to do some editing. Yes. So that famous question, can you answer that? Your
Okay.
opinion,
So,
professional opinion.
Za- Zapa Mortgage, we publish our interest rate every day on Twitter. Just look for Zapa Mortgage or Edi Shek and follow me on Twitter. We publish interest rate every day. 30-year fixed, 15-year fixed. It's there. What we can offer. Okay.
Okay.
That's first thing. Now, about the Gyan, what is going to happen? So I attend a lot of conferences. I'm actually attending mortgage conferences in Vegas for over 10 years. There's one conference happening in Houston in next 2 3 weeks or a month's time. I was in Florida as well. I listen to industry experts, the
Mm-hmm.
pundits, the people who say where the interest rate is going. So the interest rate is going down.
Mm-hmm.
Okay, it's not going down overnight like in COVID time. It like dropped like a
Yeah.
rock. No, it's not going to happen like this. So if you want to ask me a range, it's going to be between 5 and 6 by summer. Please don't wait to buy a home until summer because there are 20 million people who are waiting for that to happen. Buy now, 6 months later, you can refinance.
Correct.
Probably you
Excellent.
will pay like four extra $1,000 in interest, another $3,000 to $4,000 in refinance. That's like $8,000 for a home. The same home when you buy during that Bhagdad, that time frame when everyone is trying to buy, that home will cost $50,000 more.
Fantastic, sir. Thank you
So
so much
buy
for
home today.
buy home today. And
Today. Now, next year, the next year, 2025, it is expected the interest rates are going to be low fives, high fours. And the following year, 2026, is going to be mid fours, like 4.5. This is what is the date today? Today is 28th February 2024. I'm on the record. I'm saying that my expectation for the rates is going to go down mid years in during summertime this year, is going to down another 1% next year, is going to go down another almost 1% the following year, 2026. So today, as of today, the interest rate is somewhere about 6.7, 6.6%. So I would expect that rate to be low fives, mid fives, not next year, and mid fours the following year. Okay.
fantastic. Thank you
Yep.
so much. I know you mentioned some of your contact information in last 2 minutes. Can you give your contact and social media if someone wants to contact you and your company social media business? Can you your website, your contact information for the viewers? Go ahead,
Yes,
please.
And this way they can
Or you can
scan.
pronounce this as well if you like.
Okay, so this is what it is, and I'm going to stop sharing in a second.
Okay.
This is my phone number, 832-495-4068. This is my contact card, and within my contact card, you can visit Zapa Mortgage Facebook.
And the
Zapa
QR code
Mortgage,
is there.
yeah, that QR code is there. Zapa Mortgage Instagram, Twitter, and yeah, most of these social medias are there. So I just stopped sharing. My phone number is 832-495-4068. And you can visit our website. And website.
Mr. Eddie, once again, thank you for your time, for your generosity, for your expertise. You share. Definitely, I'm going to request you to come back to our show, and we'll go have a different conversation. I'm going to record this, and I'm recording it and put it on YouTube, and I'm going to. I definitely listen to this session after when it's posted and published in YouTube. I'm going to listen to it myself a couple of times. It's very valuable, and I'm going to even send it to some clients and that they were complaining, and people have said, now we see what I was telling you is coming from the expert. Thank you so much, sir. And you have a very wonderful evening and good night, sir. Thank you.